You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. All right, so we took a pause, answered some of the listener questions, and this week we're going to get right back into it. So we had a little thing called an election, happened on November 3rd, and Options Insider Radio had a great podcast that I kind of want to talk about. Then on election night, a lot of the speakers, frequent speakers from Options Insider Radio got together and chatted a little bit about what's going on in the markets. We had a big talk. A lot of it was about volatility, nothing really political overall, but that's kind of what we were looking at. And I did want to highlight something that I actually mentioned at the end of the podcast, and that was actually going to be my trade this week, but the marketplace stole my thunder. I was actually just looking at going into the new year, buying some out-of-the-money calls on some of the travel stocks, more so in the airline industry, but I think a little bit more speculative if you wanted to be. You could look at the cruise lines or just look at some ETFs that were tracking the airlines, like, for example, JETS. JETS, that's an ETF that tracks the airlines, or just pick your favorite airline that or the one that you feel the best about, I guess, overall. All of them are a little skittish, also Boeing. But look at just buying some out-of-the-money call options on those underlyings. And I talked about it a little bit when we were signing off on the election night process, which actually went all night long. I only was there. I attended for about an hour or so. It actually was a lot of fun. I really enjoyed it. But what has happened was when we were talking about it on the show was just in case there was some good news about the cure or the vaccine or the medicines that could help fight the coronavirus. And lo and behold, I wake up on Monday morning, the Monday after the election, and Pfizer comes out with news, which has a tendency to happen on Monday mornings, especially nowadays, it seems. And the market starts rocking, and the airlines were up around 25% in general. The market was up quite a bit. Stay-at-home stocks got sold off. Some of the big big gainers, just people took some gains on them based off of that news. But there's still a lot to learn about the vaccine. They just had positive results from a phase 3 trial, and they were better than expected, granted. So that's where we were at. So they stole my thunder. I no longer am going to talk about buying out-of-the-money calls in general in case of a cure or some good news in the coronavirus fight. Now, that went hand in hand with maybe just buying some SPY calls around the election if you decided to sell off your stocks overall. That was also one of the discussions that Mark and I actually talked about last week on the huddle up that we had with listener questions. And so this week, I'm going to stick with this theme a little bit because there's some euphoria in the marketplace, but one of the things that probably, I guess I would say this as a positive, is that we finally saw some of the implied volatilities come off in the marketplace. And, everybody's favorite volatility index, the VIX, came down from around 37% implied volatility going into the election. It's now, and I should have mentioned that we are taping Options Playbook Radio on Wednesday, November 11th, and the markets are closed. And that VIX index closed today at 2345. It was down a little bit on the day. SPX was up 27. We had the Qs up a good amount today, and the NASDAQ just in general. And then we had the Russell 2000 index was a little bit flat today. And why am I talking about the Russell 2000 index? Is one of the good signs that came after the election was the Russell 2000 index was actually kind of leading the indexes higher. And I guess if you think there is a cure or less chance of a recession because of the Pfizer announcement, you could see that might be a jump in the IWM. And so since the beginning of November, if you look at the chart, it's basically gone straight up, and we got a real big candle the day after the election to the upside. Now the market has kind of been flat, and as I mentioned, the IWM, which is the ETF that tracks the Russell, was up just a fraction today, 27 cents. And so we built a big gap. We basically gapped open from around 165 in the IWM to 170. So the Russell is unpredictable, but to go along with the rest of the volatility indexes, we actually see the RVX, which is basically the VIX of the Russell, came off quite a bit too. That was up around 45% implied volatility, and as of today, it is trading at 2786 is where I see it trading right around today, and it was down a little bit on the close today. But I bring that up because volatilities have came in a little bit on it, but I still think that this is going to be a very volatile index. So the first thing you would think about, and I might be one of the only people here on Options Insider Radar, I can't speak for everybody, I don't listen to all the podcasts, but overall, that likes to talk about buying some premium. And the buyers of option contracts overall have done a little better than the sellers. And it's mainly because we've had more volatility than what the marketplace has implied. And when that happens, if you're correct on your forecast, that should imply that if you're buying premium, you're going to do better than the sellers of premium, just overall. So I don't necessarily want to make this the paper trade, and I do emphasize, especially in the Russell, that we're talking about a paper trade here and that nothing's meant to be a recommendation. We're just looking at scenarios where we can grab a play from the playbook which might apply. And this also, one of the biggest things about my podcast that I talk about a lot is that there is really no favorite strategy overall. Somebody might would rather maybe want to be more of a seller than a buyer of option contracts. Like I would think that would be an outlook. But overall, I always like to look at what are the market conditions on the underlying that I'm looking at, and what's a strategy inside the playbook that might fit those market conditions. And it's more about the market conditions than it is about the forecast on the underlying. Our forecast, if we do this trade today, would have to be that there's going to be more volatility in IWM than less. And it definitely has wide ranges. Now, with the volatility index coming all the way down from 45 all the way down to below 30 on the RVX, it makes it interesting. Maybe if you think there's going to be more volatility, which we still don't, we still have not, we have a president-elect, but we don't have a outright winner because nobody has conceded, and by nobody I mean Donald Trump overall. So we still have some nervousness there. We still have a lot of nervousness around news that could come out with Pfizer and their big news event. So overall, I think we're going to we're just going to talk about doing something where we're looking for more movement in the IWM in a specific direction than less. And specifically, we're going to go to the downside today. We don't always really pick a direction, but there's just a gap. That gap that jumped to the upside, maybe we can fill that to the downside. It's over a 5-point gap, and that's kind of the type of move that we're looking at here if we want to do this type of trade. And not to mention the fact, like I said, we always think about conditions. If the market's going down, implied volatilities go up. And if you're doing something that likes an increase in implied volatility, well, I would rather be able to benefit from that increase in implied volatility. Okay, so let's start by looking at the long straddle in IWM. Now, this isn't the official paper trade for the week, and I do mean paper trade. We always talk about paper trades here on Options Playbook Radio. They're not meant to be recommendations overall. But if we look at this paper trade, I'm going to compare this to the real paper trade that we're going to do this week, or if I'm using air quotes here, the official paper trade, which is going to be a back spread. And I think understanding the alternative to the back spread really helps. So let's start by explaining this long straddle. So we're going to look at the November 20th expiration date. And I should mention, if I haven't already, that it's November 11th. The markets are closed. The IWM is trading at 172.63. And that would make the most at the money long straddle be the 172.50 call and the 172.50 put. We're going to only go out 9 days in time. We see the implied volatility on these options contracts. They average about 28% implied, which is right where the RVX is at, the volatility index on the Russell. And that midpoint price right now, with the markets closed, is trading for $6.09. We'll call it $6.10, so $610 if you could fill somewhere close to the midpoint, and you always have to add in commissions. That's going to be your complete risk of this trade. Now, it's only going for 9 days. Now, this is really straightforward in that if I do this trade, I got to think the market's going to move 6 points, right? If I don't think it can move 6 points in either direction, well, I'm not going to do this trade, and I'm hoping that it will move more than that, and that's my idea here. And when you're doing a long straddle and it's this close to at the money, it really is just an over-under trade. The expected move on the market based off of the options that we're looking at is around $6, so we're expecting it to go more to the upside or more to the downside. Now, we had a little bit of a breakout, then we had a pullback, and we got a big gap after the news broke on Monday. So the market gapped up from close to open, from Friday close to Monday open, and that also, a lot of times gaps like to try to fill. So we're looking at it that way. If we were just going to be I expect more volatility, this is one way that we could approach this trade. It would be a $6 debit, and that would be our total risk. And overall, it's an interesting trade to do because we just have so many unknowns, and I think it's really going to be a news-heavy week this week, just overall. And so who knows what would happen? And that's the exact trade that a lot of novice investors, right? If you're not into ratio spreads and iron condors and stuff like that, this would be a very simple trade to do. But you have a lot of susceptibility to time decay. With 9 days remaining, every day that goes by, if we get a move like we did today, which was only 27 cents, you wouldn't be as worried about the move as you would be about what happened to the time value in your option contracts. So we're looking for more as opposed to less. And an alternative trade then, and I'll bring this up, is to look at the back spread. Now, I wanted to point out the long straddle because our risk is just over $6 here. So we're going to look at something that's fairly simple to that. But we're going to, in this trade, we're going to be directional. Well, I guess we're going to be a little bit more directional than we were with the long straddle, but we're going to protect ourselves in case the market goes against us. Okay, so what is this trade? If you go inside the options playbook, this would be called the back spread with puts. And what would we be doing? We're going to be selling one in the money option contract to help pay for two at the money option contracts. So we're going to be net long an additional put with the hopes that the market makes that 6 or 7 point move to the downside. Now I'm going to say 7 because I'm going to give this more time to play out. If I look at the long straddle in the expiration that we're going to use for this trade, 23 days away, the December 4th expiration, that long straddle is trading for just over $9, it just off of the midpoint, as opposed to doing the shorter term one. And I would stick with the shorter term one just because a little bit less risk, and you're still looking for the news to kind of do something and make the markets move this week. But in this trade, because of the way we're setting it up, I don't mind going out a little further in time. We're going to have a little bit larger requirement, but time decay is an issue. And because of the way we can set up this trade, we can go out further in time and not quite put up as much capital as buying this longer term long straddle. Okay, so what is the trade? The expiration for both option contracts is going to be the December 4th expiration. We are going to sell the 180 strike put that's in the money. We're going to use those proceeds then to try to buy two at the money puts, the 172.50 strike puts. So this is a ratio spread. So we're going to enter it all as one trade. We're going to sell one and buy two, send that to the market, and the midpoint is a net credit of 11 cents to the account. A net credit of 11 cents to the account. So if you do this trade, you want the move to the downside. And how much of a move do you want? Well, you hope by the expiration date of the December 4th option contracts that the market would move at least the width of the spread. What's the width of the spread? From 180 to 172.50. So that would be 7.5 points. So we have more time for that to play out. The worst case scenario here would be that it would go down 2 or 3 and then bounce back up and go up 4 or 5 and then go back down 2. We want it to pick a direction and we want it to move. And that's our biggest concern with this, is that it meanders and kind of hangs around the 172.50 strike. So if we do this trade, our risk is that the market just stays at 172.50, that it just hangs out right there. And we have plenty of time, 23 days till that expiration date. So if I'm looking at this and the market is just kind of hanging around, doing what I'm saying, up 2, down 2, up 4, down, back 5, that type of thing, in 13 days, we're going to probably want to get out of this trade. We're going to give it 2 weeks. And then we'll have 8 or 9 or 10 days remaining, because that time premium will protect us if the option just chooses, if the index, I should say ETF, right, IWM, if the ETF hangs right around 172.50, if it just keeps meandering in that area, we're just going to get out of the trade overall. Now, the market starts going down, there are other alternatives. There are many different things you can do. You are long one more option contract that you're short. So if it goes down, you could actually sell another option contract out of the money and turn this into an upside down butterfly or skip strike butterfly or broken wing butterfly. So there are alternatives to this if it goes in your direction. That's not quite an issue. But what if it doesn't? Well, if it doesn't, you hope that it goes above 180. Now, we did this for a small net credit to the account, but all you're trying to do if it goes up is, I don't want the cheese anymore, just let me out of the trap. That's all that I'm looking to do. So if it goes up above and makes that 7.5 point move to the upside and goes beyond, well, then at some point in time, we hope that we can close this out, and maybe at expiration, we actually make the net credit, which is 11 cents overall. So that's our outlook. Where do we want this to go? We're looking for either a 7-point move to the upside in IWM, or 7.5, I should say, or a 7.5-point move to the downside in IWM. Bottom line is we're looking for more volatility in the marketplace. We are thinking that the vols have came in too much on this trade, and the increase in volatility helps us out. Why? Because we're long one more option than we are short. Okay, that's it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer on the program, you can send them directly to me at theoptionsguy@invest.ally.com. If you want to know more about the educational events that we host on both Options Insider Radio and on the Ally Invest website, check me out on Twitter. My Twitter handle is @BrianOverby. You can't get any easier than that. And thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.